Hi. In this chapter of admission of a partner, you may encounter two methods of adjustment of capital sums. In this video, we will discuss the first method. Adjustment of the old partner's capital accounts on the basis of the new or incoming partner's capital. That is, we will have to adjust the old partner's capital accounts based on the capital which is brought in by the incoming partner. Let's go to the steps which are to be followed in this method. The steps to be followed. Step 1. We will calculate the total capital of the new firm. For this, we need to use the formulae incoming partner's capital amount multiplied by the reciprocal of his share in the profits. So this will give us the total capital of the new firm. Second step is to ascertain the new profit sharing ratio. If it is not given, then we require to ascertain the new profit sharing ratio. Step 3, we need to ascertain the new capitals of each of the partners by dividing the answer of the step 1 in the NPSR or new profit sharing ratio. Step 4 is to ascertain the adjusted capitals of the partners. In other words, the capital of the partners after all adjustments with respect to revaluation gain or loss, reserves, accumulated profits and losses, and goodwill treatment. So this is step 4, to calculate the adjusted capital of the partners. The fifth step is to compare the answer of step 4, which is the adjusted capital of the partner, with the answer of step 3, which is the new capital of the partner. Where the adjusted capital is greater than the new capital, we need to pass the following entry for the difference amount. Partner's capital account debit to bank or partner's current account. So we will credit bank account if the adjustment is going to be made through cash for the cash which is withdrawn. But in case the adjustment is to be made through current account, we will credit the partner's current account. On the other hand, where the adjusted capital is less than the new capital, pass the following entry for the amount equal to the difference. We need to debit the bank account or partner's current account and credit the partner's capital account. We'll debit bank account where cash is going to be introduced, and we will debit the partner's current account in case the adjustments are going to be made through the partner's current account. So these are the steps which have to be followed for the first method, where we need to adjust the old partner's capital based on the capital which is brought in by the incoming partner. Always remember, in the absence of agreement, surplus or shortage of capital should be adjusted through cash or bank account and not by transfer to partner's current account. So where there is nothing mentioned in the question, we will have to deal with the surplus or shortage of capital through cash or bank account and not through the partner's current account. We will continue this video with two very small example sums to help us understand this concept better. The first example, X and Y are partners in a firm sharing profits in the ratio of 3:2. The remaining capitals of X and Y after adjustments are rupees 80,000 and rupees 60,000 respectively. they admit Z as a partner on his contribution of rupees 35,000 as capital for 1/5 share in the profits, which he acquired equally from X and Y. The capital accounts of the old partners are to be adjusted on the basis of the proportion of Z's capital to his share in the business. We are asked to pass the journal entry for the amount of cash to be paid off or brought in by the old partners for the purpose. So now this sentence that the capitals of the old partners are to be adjusted on the basis of the proportion of Z's capital to his share in the business. This tells us that is the first method of adjustment of capital on admission of a partner. We'll begin with the working notes. Step 1 is to get the total capital of the new firm. For this, we need to take the incoming partner's capital, which is rupees 35,000, and multiply it by the reciprocal of the incoming partner's share in profits. Z share in profits is 1/5, so I'll multiply it with the reciprocal, which is 5 divided by 1. So the new capital, total capital of the new firm is rupees 1,75,000. Step 2, we need to ascertain new profit sharing ratio. So since it's not given, we need to ascertain the new profit sharing ratio. We have that the old profit sharing ratio between the two partners X and Y is 3:2, and Z share in profits is equal to 1 divided by 5. Now this statement, they admit Z as a partner for 1/5 share in profits, which he acquired equally from X and Y. So we have that the sacrifice ratio between X and Y is equal. So it's 1:1. Hence, sacrifice of X equal to the sacrifice of Y is equal to 1/5 multiplied by 1/2, or in other words 1 divided by 10. Let's apply the formulae. Old share of X minus sacrifice is equal to new share of X. So X is new share is equal to old share, which is 3/5 minus 1 divided by 10. So we get 5 divided by 10 as new share of X, and new share of Y old share of Y, which is 2 divided by 5 minus 1 divided by 10, which is equal to 3 divided by 10. Therefore, new profit sharing ratio between X, Y and Z is equal to 5:3 1/5 will be written as 2 divided by 10. Step 3 is to get the new capitals of the partners. For this, we need to take the answer of step 1, which is rupees 1,75,000, and divide it in 5:3:2. So in the case of X, the capital is 1,75,000 rupees multiplied by 5 divided by 10, which is 87,500 rupees. In the case of Y, it's 52,500 rupees, and in the case of Z, it's 35,000 rupees. Step 4, the adjusted capitals. In the case of X, it says the remaining capitals of X and Y after adjustments are rupees 80,000 and rupees 60,000 respectively. So it's 80,000 rupees in the case of X, and in the case of Y, it is rupees 60,000. Final step 5. We need to compare the adjusted capitals. In the case of X, adjusted capital is 80,000 with the new capital of X, 87,500. So in the case of X, we find that X has to bring in cash. So he has to bring in cash of rupees 7,500. And in the case of Y, adjusted capital 60,000 with the new capital, which is 52,500. We find that Y needs to withdraw cash of 7,500. So let's pass the journal entries. Solution. Date, particulars, LF number, debit rupees, credit rupees. The first entry is for capital, which is brought in by partner Z, incoming partner. Bank account debit to Z's capital account, being capital brought in by Z. 35,000 rupees is a capital which is brought in by partner Z. The second entry, X has to bring in cash of rupees 7,500, bank account debit to X capital account, being cash brought in by partner X. Amount is 7,500 rupees. And the final entry is for Y withdrawing cash, Y capital account debit to bank account, being cash withdrawn by partner Y. Amount of cash withdrawn 7,500 rupees. So these are the three journal entries that need to be passed in this first example. Second example, A, B and C were partners in a firm sharing profits in the ratio of 3:2:1. D was admitted into the firm with 1/4 share in the profits, which he got 3/16 from A and 1/16 from B. The total capital of the firm as agreed upon was rupees 1,20,000. D brought in cash equivalent to 1/4 of this amount as his capital. The capitals of the other partners also had to be adjusted in the ratio of their respective share in profits by bringing in or paying cash. The capitals of A, B and C after all adjustments related to revaluation of assets and reassessment of liabilities were rupees 40,000, rupees 35,000 and rupees 30,000 respectively. Calculate the new capitals of A, B and C and record the necessary journal entries for the above transactions. So it says here that the capital of the other partners also had to be adjusted in the ratio of their respective share in profits by bringing in or paying cash. So this tells us that it's an adjustment of capital sum based on the first method. We'll begin with the working notes. Step 1. We have the total capital of the new firm. Given as rupees 1,20,000. Step 2. We need to ascertain the NPSR. OPSR between A, B and C is given in the sum as 3:2:1. Also, it says D was admitted into the firm with 1/4 share in profits, which he got 3/16 from A and 1/16 from B. So we have that the sacrifice of partner A is equal to 3 divided by 16 and the sacrifice of partner B as 1 divided by 16. So we'll apply the formulae. New share is equal to old share minus the sacrifice. So in the case of partner A, old share 3 divided by 6 minus the sacrifice 3 divided by 16. We have 15 divided by 48. For B, we have 2 divided by 6 old share minus 1 divided by 16 new share. (13 divided by 48). C share, which is equal to 1/6, can further be written as 8 divided by 48. And D share, which is equal to 1 divided by 4, can be written as 12 divided by 48. Hence, NPSR between A, B, C and D is equal to 15:13:8:12. Step 3. Calculating the new capitals of partners. We need to take the total capital of the firm, which is 1,20,000 rupees and divide it in the new profit sharing ratio, which is 15:13:8:12. So we get that in the case of A, the new capital is rupees 37,500 rupees. In the case of B, 32,500 rupees. In the case of C, it's 20,000 rupees. And in the case of D, it is 1,20,000 multiplied by 12 divided by 48 or 1 by 4, which is 30,000 rupees. Step 4. Adjusted capitals. Given in the sum. In the case of A, it's 40,000 rupees. The last line says the capitals of A, B and C after all adjustments related to revaluation of assets and reassessment of liabilities were rupees 40,000, rupees 35,000 and rupees 30,000 respectively. So in the case of A, it's 40,000 rupees. In the case of B, adjusted capital is 35,000 rupees. And in the case of C, the adjusted capital is rupees 30,000. So the final step, step 5, we need to compare the adjusted capitals with the new capitals. Now in the case of A, the adjusted capital is 40,000 and the new capital is 37,500 rupees. So A needs to withdraw cash of rupees 2,500 rupees. In the case of B, adjusted capital is 35,000 rupees, whereas the new capital is 2,500 rupees. B also has to withdraw cash of rupees 2,500. In the case of C, the adjusted capital is 30,000 rupees, whereas the new capital is 20,000. C also has to withdraw cash of 10,000 rupees. So let's pass the journal entries for this. Date, solution, date, particulars, LF number, debit rupees, credit rupees. The first journal entry is for partner D, bringing in capital of rupees 30,000. So bank account debit to D capital account, being capital brought in by partner D. Second journal entry, we will pass for A, B and C withdrawing the cash. So it's A capital account, debit, A withdraws rupees 2,500, B's capital account debit, B withdraws 2,500 and C capital account debit, C withdraws 10,000 rupees to bank account, 15,000 rupees. Narration being cash withdrawn by A, B and C. So these are the answer, the two journal entries for the second example sum.